Welcome back to Investing Talk Podcast. Today we're tackling a question many of you are asking. Is Navitas Semiconductor a good time to buy now? We've gathered insights from several key sources, digging into everything from market chatter to their hard financial data, really trying to give you a clear picture. And as always, we love hearing from you. If you find this discussion helpful, please remember to subscribe, like, and maybe leave a comment. You could even consider buying us a coffee if you appreciate our work. And hey, if there's a specific company you want us to look into, just drop it in the comments below. Okay, so we're going to explore the hype around Navitas, then look under the hood at its financial realities, its market position, and what the future might hold. We'll give you the crucial info you need.
Yeah, it's really interesting the amount of buzz around Navitas right now. I mean, the community discussion is definitely trending, and it seems largely fueled by a couple of big things. Those rumors of a potential acquisition, maybe by someone like NVIDIA, and its really crucial role, in powering AI data centers. That's huge right now.
Absolutely huge. And you also hear whispers about the new CEO, some insider activity, NVIDIA partnerships. It's a lot.
It is. There's talk about competitors, tariff risks, all sorts of things swirling around. But, at its core, Navitas is about gallium nitride and CFC, silicon carbide, power semiconductors. These aren't just buzzwords. They're key for high-efficiency power conversion. Think faster charging, smaller power bricks, which makes them pretty essential for fast-growing markets like EVs, renewables, and, those power-hungry AI data centers again.
Right. So the tech itself sounds genuinely exciting, making things run better more efficiently.
Exactly. It's a big deal for innovation. But the million-dollar question, I guess, is does all this excitement, this potential, translate into a solid investment opportunity today?
Okay, yeah. That's the critical point. Exciting tech, lots of buzz. But let's unpack the numbers. As we always say, the financials tell a story. So let's look. For the quarter ended March 31st, 2025, Navitas reported net revenues of $14.0 million. Now that's down quite steeply from $23.2 million in the same quarter last year.
Wow. Yeah. That's nearly a 40% drop. That's significant.
It really is. And it hits harder when you see their gross margin also declined.
Because costs stayed high relative to that lower revenue, right? They had $8.7 million in cost of revenues against that $14 million revenue.
Exactly. So that puts a squeeze on things even before we get to operating expenses.
Right, which were probably pretty high, too.
Oh, yeah. Operating expenses totaled $30.6 million. So that leads to a loss from operations of $25.3 million for one quarter. Even after adding back some other income, like a gain from earnout liabilities, the pre-tax loss was still $16.5 million. So the bottom line is the company keeps operating at a net loss. There's no consistent profitability here.
Okay, so operating losses. That points towards potential issues with financial health overall, doesn't it?
It does. As of March 31st, you see challenges. They had this negative allowance for credit losses of $481,000.
Negative allowance. That's a bit unusual. Suggests maybe some issues with receivables or how they're forecasting them.
Could be volatility there. It's not a massive amount against total assets, but it's another little flag. The bigger issue is the ongoing net losses suggest a high cash burn. That's likely to continue until revenue turns around or they, really get costs under control.
Right. Burning cash when you're not profitable is always a risky position. Any bright spots?
Well, maybe a small one. The fair value of earnout liabilities dropped quite a bit, down to $2.1 million. That might suggest future milestone payments are less likely, which could marginally help liquidity down the road, but it's small.
Okay, so a tiny positive against a backdrop of losses and cash burn. What about their competitive standing? The tick is cool, but are they big enough to compete?
That's another key point. While the GaN and SiC tech is advanced, Navitas is, relatively speaking, small compared to the giants in the semiconductor world. Those big players have much larger R&D budgets, deeper customer ties. Navitas has limited operating leverage too, and high R&D spending as a percentage of their sales. That makes near-term profitability, difficult.
So for you, the listener, what this means is exciting tech, yes, but the company's current financial picture, it shows some serious headwinds. It's a growth story that's still trying to find its feet, basically.
Exactly. A classic case.
Okay, so given those financials are, let's say, challenging,
Yeah.
how is the market valuing this company? That often tells a different story, right? High hopes versus reality.
Right. Let's look at valuation.
When we look, we definitely see a story of high expectations. As of August 2025, Navitas has a market cap around $800 million. That's based on its share price floating between, say, $6 and $7. Now, the PE ratio, price to earnings, is meaningless because of those losses we just talked about. No earnings, no PE.
Makes sense. So what can we look at? Price to sales.
Exactly. If we annualize that Q1 revenue, just roughly $14 million times 4 gets you about $56 million for the year. Their price to sales ratio, PS, comes out around 14.3 times.
14.3. Wow. How does that compare to others in the industry?
It's substantially higher. The power semiconductor industry average is typically more like 4 to 6 times sales, and that's for profitable companies.
Okay, so a PS of 14x versus 46x for profitable peers. That's a huge premium.
It really is. And the price-to-book ratio is also estimated above 5x. These ratios clearly scream rich valuation. It's a valuation reflecting hope, lots of hope for future growth, not the current financial reality.
So no discounted cash flow model is possible here then?
No, not really feasible for a loss-making early-stage company like this. There's no reliable positive cash flow to discount back. So relative valuation is what we have, and it clearly shows a premium compared to the sector, compared to competitors. And that premium just isn't justified by the current profitability or, frankly, the growth momentum, which is actually negative right now.
And why this matters to you, the listener?
It matters because it tells you the market has already baked in a massive amount of future success. If that success doesn't show up fast, or if they stumble, there could be significant downside risk to the stock price. You're paying for perfection that isn't there yet.
Okay, tough financials, sky-high valuation. Let's look at the technical side. How's the stock actually trading? Any recent news shaking things up? So recent price action, August 2025, has Navitas trading between $6 and $7. But that's after a really steep slide from its highs, right? Wasn't it above $15 back in 2022, 2023?
Yeah, it had quite a peak back then, so long way down from those levels. Indicates a shift in sentiment, clearly.
Definitely. Looking at the chart, core support seems to be around that $5.86 area. Resistance looks like it's near $7.50. The price has kind of stabilized a bit after those sharp drops, but it's still jumpy, prone to short-term swings.
And the technical indicators, what are they telling us?
Well, the 50-day moving average is below the 200-day. That typically confirms that longer-term downward trend. The RSI, Relative Strength Index, is kind of middling, maybe 45 to 55. So neutral momentum, not really oversold or overbought right now. And the MCD indicator is still negative. That's consistent with a more bearish intermediate-term setup, and volatility seems low currently. Overall, the technical picture isn't looking bullish.
Okay. And there was some news recently, too, wasn't there? Management changes.
Yes, big news, actually. On August 20th, 2025, Navitas announced that Alexandra will take over from founder Gene Sheridan as CEO. That's effective August 31st. So a major leadership transition is happening right now.
A founder stepping down, new CEO coming in. That always adds a layer of uncertainty, maybe opportunity, but definitely uncertainty. What about insider activity?
Right. On August 21st, the CFO, Todd Glittman, had about 3,882 shares withheld. But this was to satisfy RSU withholding taxes restricted stock units. It wasn't an open market sale. And importantly, he still holds nearly 1 million shares. So it suggests insiders are still holding significant positions.
Okay, that's good context, not necessarily a red flag sale. And sentiment online, you mentioned the buzz earlier.
Yeah, social media sentiment seems pretty mixed. You see some optimism, maybe pinned on the new CEO bringing change, but also a lot of skepticism about whether they can actually turn the financials around, echoing our earlier points.
Right. So putting it all together, the technicals look weak, bearish, really. And a new CEO, well, it can bring fresh energy, absolutely. But it always introduces execution risk, doesn't it?
It really does. Strategy shifts, operational hiccups.
Yeah.
It's a period of adjustment.
Okay, so if we connect this all to the bigger picture, what are the potential catalysts investors might be watching for? Short term, everyone's eyes will be on that Q2 2025 earnings report, probably due in September. They'll be looking hard for any sign of revenue stabilizing, maybe some cost control, and of course what the new CEO says. Their initial strategic updates could really move the needle on sentiment and volatility.
Makes sense. And longer term, what are the hopes there?
Longer term, it's about those design wins, new customer signings in automotive, EVs, renewables, AI infrastructure. That's where the growth could come from. Also, maybe regulatory tailwinds, green energy incentives, or just broader macroeconomic demand for efficient power chips. Those are the potential game changers down the road.
Okay, but those are hopes. Let's talk risks. Every investment has them, especially a speculative one like this seems to be. What should listeners really be aware of?
Yeah, risks are crucial here, stock-specific risks. Well, number one is continued operating losses and cash burn. That significantly increases the risk they'll need to raise more money, possibly diluting existing shareholders, making your piece of the pie smaller. Then there's the execution risk with the new CEO we mentioned. Transitions can be disruptive. And the company faces revenue concentration risk, relying too heavily on a few customers in a market that's still emerging, but already fiercely competitive.
Right, and beyond the company itself, market and sector risks.
Definitely. The whole semiconductor industry is cyclical. Demand swings up and down, supply chains can get messy, and there's always the threat of new tech disrupting things. Plus, broader market volatility in U.S. tech, worries about interest rates, inflation, all that can pressure valuations, especially for high multiple stocks like Navitas. And don't forget competition from the big, well-funded semiconductor companies. They aren't standing still.
Okay, that's a lot to weigh. So after digging through all of this, the exciting tech, the difficult financials, the high valuation, the risks, the potential catalysts, what's the final verdict? What's our investment thesis here?
All right, considering all these factors, our overall rating for Navitas Semiconductor is a 3 out of 10. It is pretty clearly a speculative small cap growth play in the power semiconductor space. That's what you're looking at here. The company remains unprofitable, revenue is declining currently, the valuation metrics are really stretched, totally disconnected from current performance, and it's heavily dependent on a future growth surge that just isn't visible in the fundamentals right now. Plus, the CEO transition adds another layer of uncertainty.
So not exactly a ringing endorsement.
No. While the long-term potential is there if GaN and Tech really takes off and Navitas executes perfectly. The near-term risks and the complete lack of profitability are just major negatives right now. So from an investment horizon perspective, it doesn't look attractive for short-term trading. There's no real momentum, the catalysts are unclear, and it's volatile. And for long-term investment, it just feels too risky until we see tangible proof quarter-over-quarter revenue growth returning, real cost discipline, and a believable path to actually making money.
Okay, so the bottom line recommendation.
Our assessment is that Navitas Semiconductor is best placed on a watch list. Keep an eye on it, sure, but it's not an active buy right now. Not until we see significant improvements in those fundamentals or some clear strategic advantage starting to emerge.
Right. So while Navitas Semiconductor operates in a genuinely exciting, important sector, the financials, the valuation, they all scream caution for investors at this moment. It's definitely a company to watch, particularly for its technology, but maybe not one to jump into with investment dollars just yet, given all these headwinds. And that leads to a thought as we wrap up. When you look at companies like Navitas, what grabs you more? Is it the big, exciting vision, the cutting-edge tech, or do you find yourself digging first into the, let's say, gritty details of the balance sheet and the income statement? Something to think about as you make your own informed decisions. Thank you for joining us for this analysis of Navitas Semiconductor. We hope this gave you some valuable insights. We'll be back soon with another company breakdown. Until then, stay informed and make smart choices.